What you're seeing right now on the screen is a heat map of the software sector in the stock market. It has companies like Adobe, ADP, and SAP. Today, we're going to be taking a look at a stock that I consider to be very undervalued, and I hope that it outperforms in the future. And that stock is going to be ServiceNow. They're a cloud-based platform that helps other companies automate workflows. So pretty much messy emails, worksheets, whatever it is that other companies do, ServiceNow helps them pretty much take better care of it. Now, as you can see in the 1-year chart, they're down about 53%. So they were almost at $200 per share. If you can see here in the 52-week high, they were at $211. If you just take a look at the PE ratio, it does look a little bit expensive at 54.22, but they still have a market cap of 93 billion. Now, we are going to be taking a look at the intrinsic value of this company to see if it's even worth buying, but that's not what we're taking a look at it now. This is sort of the average intrinsic value throughout time that the stock could be worth. As you can see, this gray line here is the intrinsic value, and then the red line is when it was overvalued, and below the gray line is when it's undervalued. So right now, for the first time in a bunch of years, ServiceNow starting to look undervalued, so it's starting to look like an opportunity for me. Now, this isn't financial advice. This is just the way that I like to invest. Of course, you have to take a look at other metrics, which we're going to see now, but this is definitely catching my attention. One thing to keep in mind, though, is that their last earnings, they did miss on EPS, but they beat on revenue. So this is why the stock is also getting hit, as there is so much fear of AI that if you don't report great numbers, and even if you report outstanding numbers, your stock could still fall. So if you're planning to invest in this company, that's something that you can take a look at. And if we go back to the heat map, as we can see, ServiceNow is also here. I'm not sure if you guys saw it at the beginning, but as you can see, it's one of the companies that I have lost the most in terms of price, and this is a 6-month performance chart. They are down about 50%, while big companies like CRM and SAP are down only 26 and 34%. One way that I like to invest in companies is comparing their price to their EPS. I like companies where their EPS are increasing but their price is falling. Now, ServiceNow chart is a little bit all over the place. As you can see, they had very small growth, and then they had a very big growth in about 2023 throughout 2024, and that started diminishing a little bit, but they're starting to climb back up. And as you can see, even though the EPS are increasing, the price is falling. Again, this is due to the fears of AI. However, if we take a look at the free cash flow, if a company has more cash flow, is that they're using their money wisely, or at least they're making good use of the profits that they're making. It's better to have the cash flow than to just spend it and have liabilities. As you can see, it's the same case. Cash flow is increasing, the price is decreasing. If we take a look at the shares outstanding, it's pretty much the same. It's remaining at about 1 billion shares. This means you're not getting diluted as an investor, which is a very good thing. And then if we go ahead and take a look at the revenue, I mean, look at this healthy, steady growth chart, and once again, the price is just falling down. If we go ahead and take a look at the operating income, it's going to be the same thing. You have a healthy chart up, and then the price just keeps falling. And then just to not bore you, let's go ahead and take a look at the net income to be the last chart. Of course, again, the huge growth in 2023 to 2024, and then now it's starting to stabilize a little bit. However, the price of the stock is still falling. Now, if we take a look at the overall financials of the company, we can see that the numbers are pretty healthy. The revenue is up 21%, operating income is up 34%, apologies. These numbers do not look like the numbers of a company that's getting killed by AI. So the market, I think, is overreacting a little bit. And if we take a look at other metrics, we can go ahead and see the gross margin is at 76%. This is crazy. And even if AI was a fear that this company could have, I think it would be the only way around. I think these type of companies can actually implement AI in their software to actually make more profits and make their business a lot easier. Now, this is not the intrinsic value we're going to be taking a look at. This is what analysts expect of this stock. They have a low end of 85, an average cost of 149, and then they have a high forecast of $252. Now, the only thing I don't like about this stock right now is this that we're seeing on the screen right now. The buyback yield is negative. This means that the company itself, or the main shareholders, or the owners, or the CEO, they're not buying back the shares of the company, which could mean that they still think the company is a little bit overvalued, or they think that the company might get hit a lot more by this talk of AI, and they're expecting an even more drop to then buy, well, hopefully buy in the future for the stock to then start heading back up. Now, however, if we go back to Seeking Alpha and we take a look at the Wall Street analyst rating for this company, as you can see that out of a 5 rating, they have a 4.56. This consists of a 48 total analysts in the last 90 days. They have 34 strong buys, 9 buys, 4 holds, and 1 strong sell. Now, this company is expecting a lot in terms of revenue growth. The sector median is about 10%, and ServiceNow is currently at 21.72, so pretty much double the sector median, and the 5-year average is going to be around 24.74. So there's still some good growth expected for this company for the revenue. Their net income is expected to increase as well, just like their diluted EPS. So now what you've all been waiting for is time to see the intrinsic value. As we can see here, we're going to have 3 cases: a bear case, a base case that you're seeing now, which is $126, which is still undervalued by 28%, and then the bull case. In the bear case, we're even undervalued by 1%. Although you're not investing to make 1%, but at least it's good that you're not buying it at a fair price or above the price that it's supposed to be worth. Again, guys, this is just a metric. There are other things that you got to keep in mind. And the bull case scenario for the stock is that it's undervalued about 46%, meaning it could have a potential stock price of $167. After seeing all these numbers, after seeing the intrinsic value, after maybe if you did a little bit of research in terms of the AI that every company's scared of right now, what do you think of this company? Do you think this is a potential comeback play? You think it's worth it to even add to a portfolio? I would love to hear your comments in the comment section below. If you enjoyed the video, please consider leaving a like. Don't forget to subscribe. And as always, I'll see you in the next video.